Bismillahirrahmanirrahim. Today our topic is bad debt accounts, or we can say is as a doubtful debt. Now, it is a very important topic because in accounting treatment, the bad debt is very normal, and we have to estimate it as an expense. First of all, we have to know actually what is bad debt. As you know, that there are two type of sales. Cash sales, or we can say credit sales. If credit sales occur, then there is a deferred payment, like you haven't received payment in cash, you will receive cash um, later on at any future date. But sometime it is not possible that you will get back your estimated amount on the estimated day. Let's suppose you there's a credit sales of rupees 1 lakh, and the customer said he will pay in a week, but in that week maybe he will not pay. So what will happen? Maybe there are number of reasons, numerous reasons due to which you may not receive your payment of credit sales which you have done before with your customer. So it will be the loss for a business. But not all credit sales or deferred payment will fall into the loss. Most of the payments will have to be received on time or after some time or maybe before time, but still there is a probability that maybe you will not receive payment on time. So what happened? So from credit sales, there is an issue that we have to calculate a bad debt expense. We have to estimate our specific amount that such value may not receive in a meantime. So we call it as a bad debt expense, and it is an admissible deduction, or we can say it can be treated as an operating expense, and therefore we may subtract it from our gross profit before calculating the net profit. But if such amount uh, is certain that it will not receive in a future due to any reason, due to death of the customer, due to insanity of the customer, due to his bankruptcy, due to his solvency, maybe he will not available, he closed his business and went out somewhere where you don't know. So what happened then? That amount we can say that as a written off. What does it mean in the language of accounting? Written off. Written off means that that amount is has been certain that it will not receive anymore due to any reason. So from credit sales, we have to calculate the value of the bad debt expense, upon a certain rate, up to the certain rate that that amount may not be receivable. But when it will become certain that it will not be received in the future, then we call it as a written off. There are two methods for calculating bad debt expense. If we talk about the methods, the first method is income statement approach, and the second method is balance sheet approach. Under the income statement method, there is a method we can call it as credit sales method. Okay, and the balance sheet approach, there is account receivable method, and the second one is aging method. So all in all, we have three methods. Why we call these methods as income statement approach and balance sheet approach? I will uh, try to clear it when we do our calculation. But still, I want to say one thing, that under the income statement approach, you have chosen the values from the income statement, and the calculating amount will also go into the income statement. How? I will show you later. Under the balance sheet approach, you will choose the value of from balance sheet element, and the resulted amount will also go into the balance sheet approach. Balance sheet, we all know that under the income statement there are revenues and expenses, whereas in the balance sheet there is asset, liabilities, and equity. So let's start our today's topic with the income statement approach. Now, under the income statement approach, we have a method of credit sales. So let's start. Let's suppose we have a credit sales of rupees 7 lakh, and we have a credit sales return of rupees 10,000, and also we have a credit sales discount of rupees 20,000, and cash collection from customer is rupees 1 lakh, and we have estimated value of 2% bad debt rate. It has been given in our questions. Bad debt rate on credit sales. This is our question, and we have to calculate the bad debt expense and net receivables. This is our question. We further add here the opening balance of account receivable is rupees 3 lakh, let's suppose. Now the first part to calculating bad debt is to pass the journal entries. So I'm writing here is step one, just for your understanding. We have to pass journal entries. You have to prepare um, formal journal, but here we are doing roughly like credit sales. We all know under the credit sales, we have account receivable debit and sales credit. So account receivables is of rupees 7 lakh and sales credit by rupees 7 lakh. Make sure that during the calculation of bad debt you have only consider credit sales, not the cash sales, because bad debt will be estimated only on the credit sales, because under the cash sale you have already received your cash, so nothing, there is no risk involved. Second one is credit sales return. So sales return will be debit, and your credit sales, sorry, credit sales return, yeah, sales return is debit, and account receivable has been created. So sales return is of 10,000 and account receivable is also 10,000. Now the other credit sales discount. So you know sales discount is also an expense. So sales discount has been debit, that is 20,000, and account receivable is credit, that is 20,000. And the last entry is cash collection from customer. Customer means he's the one to whom you have incurred credit sales, and he has paid back you rupees 1 lakh. So cash has been debit by rupees 1 lakh, and account receivable has been credit by rupees 1 lakh. So this is the first step of journal entries. That's it. Here we also add one more thing, that the allowance for that opening balance is rupees 1000. Now this is the first step here of journal entries. You have to pass your journal entries under the journal with the narration as well. Now let's move to the second step. Step two. Step two is to prepare T accounts or journal ledger of account receivable and allowance for bad debt. That's it. You have to prepare your T accounts. Let me, let me correct it here. Okay. Now here's account receivable first. Account receivable. This is the debit side and this is the credit side. Okay, what is opening balance? The opening balance of account receivable is rupees 3 lakh. So we have write down 3 lakh in the opening balance. Here account receivable in the number one journal entry is has been debited with 7 lakh. So number one, and here is 7 lakh. Now this is account receivable. Say here account receivable has been credited with a 10,000. You will write it as a 10,000, and this is a journal entry of 2.1. In third entry, this is second entry. In third journal entry, the account receivable also credited to the to 20,000. So account receivable has been credited to 20,000. And in the last entry, account receivable, the fourth one, account receivable has been credited by 1 lakh. So it is 1 lakh here. Now the total value here is, we have to write here 1 lakh. We have same issue with the decimal places. Okay, the total value of debit side is rupees 1 million. We all know it. So total value is 1 million, and we have to write it here as 1, 2, 3, and the same value should be here 1, 2, 3, 1, 2, 3. But if we sum up these values like 1 lakh and 30,000, we have to subtract here, and the ending balance is 8 lakh 70,000. This would be our ending balance, and it is a account with receivable T account. Now we have to make another account, and it would be incomplete because we have to calculate further. Well, here is a debit and this is a credit. Make sure whenever allowance for bad debt opening balance has been given, it may be on a credit side or debit side. Until unless it has been mentioned that it's on debit side, we assume that the opening balance is a normal credits balance. So we have write the opening balance here 1000 and just leave it here right now. Okay, so we have to leave it here. Now we have to move toward the step 3. Now what is the step 3? Under the step 3, we have to calculate the bad debt expense under the credit sales method. Under the credit sales method, you have to write down first the credit sales, that is rupees 7 lakh. You have to subtract credit sales return, that is rupees 10,000. Make sure all values in all these values will belong to the current financial period, not the previous one. So, and there's a credit sales discount as well. It is also 20,000 rupees. Now we have to calculate the net credit sales. The formula of net credit sales is credit sales minus credit sales discounts minus credit sales return. If under the question it is mentioned that is a cash sales return, cash sales discount, then you will not or you cannot subtract it from the credit sales. So the value is 6,70,000 net credit sales. That's it. Now the formula would be net credit sales into rate. So our net credit sales is 6,70,000 multiplied by what was the rate? Rate was 2%. So here we can write it as rate as 2%. So when we calculate these value, 6,70,000 into 0.2, the value is 1,34,000. Sorry, it's 2%, so we have write another zero here. So this is 13,400. So the value of bad debt for the current year is rupees 13,400. Now, what will be the general entry of bad debt expense? So bad debt expense will be debit by, by rupees 13,400, and similarly allowance for bad debt will be credited by 13,400. Now, as we see that here allowance for bad debt T account is incomplete. Here we can see that allowance for bad debt credit balance is 13,400, right? So we have to write down 13,400 on the credit side. So we have to write down the 13 allowance for bad debt has been credited with 13,400. So we have write down the 13,400 here. So the ending balance should be 14,400 here and 14,400 here as well. Therefore, the closing balance will be here 14,400. We have to close our T account here by 14,400. Now in the last step, we have to calculate net receivable. So here we have to write account receivable ending balance. And ending balance of account receivable is 8,70,000. So you have to write down here is 8,70,000, and you have to less the allowance for bad debt ending balance, that is 14,400. So when we subtract 8,70,000 minus 14,400, the value of net receivable will be this one. Therefore, we have done with all our requirements. Therefore, we have done with all our requirements here. This is our net receivable, and that's it. This is your final answer of net receivable. So uh, we've done step 1 general entries, step 2 T accounts. We have to calculate the ending balance, and here is step 3 calculation of depreciation expense, and last step is net receivable. So this is all about the first step of better expense under the income statement approach, that is net credit sales method. Thank you so much.